let's talk about the amount of money the Browns saved by doing some awesome tax strategies. They applied 5 different tax strategies in this case study, and I want to show you how much tax they saved. They literally decreased their cash flows by $30,000. So technically they've invested about $30,000 and turned it into $45,000 guaranteed. Who wants a $15,000 return on your investment? This is a very common situation. Let me show you what they did. So you have Mark and Sarah Brown. As a recap of the case study, they have $150,000 in gross income, okay, from their salaries. They have some taxable interest, dividends, a bit of tax exempt interest. We have, and I'm going to zoom in here, capital loss of $3,000, giving them total income of $150,200. They have itemized deductions, but they don't quite reach the standard deduction amount of $29,200, and that's because their medical had a phase out. But by decreasing their AGI, we're going to actually allow them to itemize their deductions. So we'll show you that. AGI of $121,000, they're paying for their tax liability $16,726, but they have that child tax credit and dependent tax credit as well. $2,000 child tax credit, $1,500 for 3 dependents, giving them $13,226 that they're due to pay. Okay, so that's where we're starting. That's our baseline. And whenever you're doing some tax planning, you always start with the baseline scenario, and you can see there's our baseline. We've also included, there's their federal tax. We also have included their Utah tax due and their Social Security and Medicare. Okay, so $30,785 is their total tax that they're paying. And they're in that 22% marginal tax bracket for federal. So let's set up the tax planning strategies that they used. My first and favorite, 401k match, okay? Because this is about the best ROI you can get with any of these tax strategies, okay? So with the 401k match, his employer matches 5% of his wages, okay? So we have Mark's getting a 5% match by his employer. So to get the full 401k match, he's going to invest $4,250, which is just his $85,000 salary. We'll go up there, times the amount his employer is contributing. So because they're going to match him dollar for dollar. So every dollar he puts in, they're putting in $1 up to 5%. So in order to get that full match, he's going to do 5%. What effect does that have? Well, here was his baseline tax. We saw it from above, right? Just by getting the employer match, what was his ROI on that investment? Well, he saved almost $1,200 in tax. He got a big decrease to his federal tax, and then he also decreased his state tax. No effect on Social Security and Medicare, okay? So because of that tax savings, instead of investing $4,250, he gets that $1,182 back, so it only cost him $3,068, and now he has $8,500 invested because he got the match. So $3,068 invested, $54.32 return on investment, 177% guaranteed return on your investment with that 401k match. Okay, we included the tax savings plus whatever the employer put in. And you could do Roth, and I have other videos on when you would want to do Roth, etc. But we're just doing the traditional for now to get that tax savings. So there's our first scenario. I copied it and pasted values so we can compare that to the other strategies that were applied. Okay, so the first one was 401k match. My second favorite, max out the HSA. The HSA has so many benefits. I also have a video on that where you get 5 different tax savings through this HSA account. It's the best tax savings vehicle you can invest in. So what we're going to do is our second projection is we're going to say we're going to add $8,300 to that HSA. Okay, there's 2 places you can contribute to an HSA. You can do it through your paycheck, so you're telling your employer put X amount per month into the HSA or per paycheck in order to hit the max of $8,300. The other way, well, what's the effect of if you do $8,300 out of your paycheck? How much tax do you save? $4,130. I'm going to show you why you actually save less if you do it out of your pocket. Okay, instead of having it deducted from your paycheck, you can contribute to an HSA out of pocket, but look what we're at. It was $4,130 before. That's like a $700, $650 difference because your Social Security and Medicare, you don't save any Social Security and Medicare when you pay it out of pocket, but if your employer puts it in, you actually don't have to pay Social Security and Medicare tax on that. So you can see we're actually saving on Social Security and Medicare as well when we do it from our paycheck. So 2 strategies applied. What's their ROI? 100%. If you just applied these two strategies, you literally decrease your after-tax cash by $8,420, and you get another $8,380 in your pocket by your employer match. Plus, you've saved $4,100 in tax by applying these two strategies. Okay, amazing, right? $16,800 invested, and you only had to put away $8,400. Okay, if only people were budgeting a little more and doing this stuff, they just set themselves up for life. Okay, so that's our second projection. Third strategy they're applying. Okay, instead of just getting that 401k match, Mark's going to say, look, I'm going to max out to the max 401k I can possibly do, so $23,500. So we're going to change this to $23,500. And you can see I've already laid out the projections we're doing in these columns, and then I'm just changing column D where the projection actually affects the calculations below. So what does our tax savings look like now? Because we're getting, that's decreasing. Look, we've dropped to the 12% bracket, and there's a strategy where, oh, we're into the 12% bracket. Maybe we want to just fill the 22% bracket and do the rest Roth. You know, there's so many different things you can do, but we've dropped them into the 12%. They're loving that, right? So they've now saved almost $9,000 in tax in 1 year, going from almost $31,000 to $22,000 in tax by maxing out that 401k and the HSA. So they've invested $22,874 because we take however much they put in and then subtract out any tax savings, right? That's cash back in their pocket. Total investment at this point is $22,874, and they've gotten a return of $13,000 on that investment. These are huge returns, right? You only had to save $23,000, and now you have $36,000 saved. Okay, these are the things that turn around people's retirement when you start applying this type of strategy. Okay, so there's our third. But obviously, to save this kind of money, you have to either have good wages or you're on a strict budget in order to make this happen. Okay, so. But we're still at a 58% return on investment, which, gosh, we're happy if the stock market's up 12%, right? Or whatever our other investments, but 58% guaranteed. This is the tax code. If you have a deduction, you're guaranteed that deduction of 22%, right, on that dollar you invest. Okay, so 58% to this point. That's three strategies. We did 401k match, plus we maxed out the HSA. Now we fully maxed the 401k. Let's do projection 4. Now invest tax savings in Roth. A lot of times people are saying, what's better, traditional or Roth? If you're just doing traditional or Roth, and let's say you were doing $23,500 in one or the other, Roth's always going to win out because that's growing tax-free. The way traditional a lot of times will win out if you're not doing the $23,500 is you're investing the same amount in the account, but then whatever tax you saved, you go invest that. Okay, because then the traditional, your balance will grow much bigger, and maybe you're paying more tax in retirement, but your balance is that much bigger. Okay, so I also have videos on the comparison between the two. So you always want, when you're getting that tax savings, invest it in a tax-free account. Okay, and there's limitations to when you can put money in, but they haven't hit this threshold. Okay, so they're going to put their tax savings in a Roth, and look how much they've almost saved $9,000 in tax. So here, they're going to fully fund spousal Roth. Okay, so we're going to do $7,000 into Sarah's Roth. Okay, but we want to invest all the tax that we've saved. So we've saved, let's put another $1,926 into Mark's Roth, 1926. So how much have we invested now? $31,800, and that is including the decrease from our tax savings. So in total, we have $45,000 saved up in Roth, HSA, Roth accounts. These are two tax-free accounts, grow tax-free. We have deferred as well. There's so many strategies you can do with a deferred account, okay? Yeah, so we have a ton of savings here, $45,000, and it only cost them $31,800. Well, guess what? With our last strategy, let's copy that. Our return's a little lower, but we have a lot of money put away now, okay? Still in the 30s, like, who wants a 30 or 41% return on your investment? Okay, these are crazy numbers. Fifth strategy they applied, okay, and this is called charitable contribution stacking. As you noticed, in our baseline scenario, they took the standard deduction because their deductions were below the $29,200, and their medical, it actually had been phased out when their AGI was too high, so it had phased out their medical. So their original itemized deductions were only like $28,000, but because we lowered their AGI, now they could actually itemize and get a bigger medical deduction. So that was another benefit, another tax savings from lowering that AGI, okay? So we're at $30,620. Because they're so close to the standard deduction amount, all of these expenses aren't giving them a huge benefit, right? It's only the difference between the $29,200 and $36,620 that's the benefit. Well, the strategy is, if you're paying $5,000 this year and $5,000 charitable next year, why not pay $10,000 this year to increase your itemized deductions and then take the standard next year? Then the amount that you decreased your deduction times your tax rate is the benefit, okay? And maybe they could apply it next year because they're in the 12% bracket. These are all strategies you want to look at. But these guys decided, okay, December, we're going to pay next year's charitable this year. So they paid an additional $5,000 doing charitable contribution stacking. What does that put them at? Now they have itemized deductions, which are quite a bit higher, but there's no additional cost. There is some time value of money, but within a year, it's not a ton, right? So this year's, whatever they were paying next year, they're just going to pay in December, okay? So it's not costing us anymore. So you can see our total investment amount actually went down because we just saved another $31,800 minus $30,900. We saved another $900 in tax by stacking our charitable into 1 year. Didn't cost us any more money. The timing was the only difference, okay? So in order to get $45,000 invested, it cost them $30,900 with a 46% guaranteed return on your investment, okay? These are all strategies that ordinary tax, you don't have to be a business owner to apply any of these strategies, okay? Any ordinary taxpayer can apply these strategies and really expedite your wealth accumulation. 45 grand in 1 year, do that a couple years, and as that balance gets bigger and bigger, your wealth starts to explode. I have videos on that, like get to 100,000 as fast as you can, because once you do, your wealth, the capital is what's going to work, and you're growing your wealth very quickly. There's your strategies, the tax planning strategies for the Mark and Sarah example, and please reach out with any questions.